Hey everybody, welcome back to the channel. Okay, today we're reacting to another YouTube channel called Everything Money and some analysis they just gave on Palantir. Now, a couple things I want to say before we get into this reaction video. Number one, I like this channel. I don't think this channel is bad. I actually watched a decent amount of their videos over winter break, which is when I discovered some of their content, and I enjoyed it. I mean, the personalities are unique. They have unique talking points. They obviously have their own spaz. They have their own ideas around investing, and they're not afraid to sort of impose those ideas, and they're really honest about it, right? So I respect the transparency. The only problem I really have with this channel is when they analyze certain stocks that other people have done immense amounts of research, maybe hundreds of videos worth of research, and not just research as in click the title because this stock's going to 5,000, right? Like that's not the type of content I do. And I really don't think that you should be watching people that do that type of content because a lot of times they have really weird ill intentions when they're making that type of content, but rather people who have done the research about stocks and gone extremely deep into the underlying structure of what these companies are supposed to do, what these companies can do, and what they are doing right now that is setting them up for a very strong potential trajectory. Those stocks are ignored by these guys because they don't fit into the metrics that they evaluate. And I get it, right? Because they have a process. They are from the value investing side versus the growth side. They think everything Cathie Wood does is pretty idiotic. They are huge fans of Warren Buffett and Charlie Munger, and those guys are amazing investors. But the problem is they generalize a lot of these stocks into their pool of just like companies you shouldn't invest in because you're overpaying too much for growth. And as a result, I think they miss out on some key elements that it's important that are important to understand because they just don't go deep into every stock. So all the stuff they're going to say about Palantir today, we're going to talk about it. I doubt these guys actually know what Palantir does. I doubt these guys have actually researched Palantir. And I'm pretty sure if they're watching this video, they would agree that, yeah, they probably know nothing about what Palantir does. And that's fine. But the problem is you can't say that the stock is worth $5 or $7 when you don't know about what they do. And that's kind of what happened to them with Tesla, which is why they missed out on all of Tesla. They missed out on all of Amazon. We're going to talk about that as we get into this video. But yeah, let's react to it. Overall, I like these guys. This video is not meant to be hostile or anything like that. I just have a fundamental disagreement with how they think about certain growth stocks, and their analysis on Palantir to me is not good. And that's why I'm doing this reaction video. If you guys are watching this video, we have a disagreement of opinions. That's totally fine. We're allowed to disagree. But if you guys are watching, then yeah, I would love to see your thoughts and analysis to what I have to say as well. Let's get into the video.
I believe in Peter Thiel a lot. He's a brilliant man. He started this company in 04, 03. It's just too expensive. Just like I like Tesla, but it's too expensive. I love.
All right, so let's first break that down. Likes Peter Thiel, but Palantir is too expensive. Likes Elon Musk and Tesla, but it's too expensive. So the problem is what they're not really going to talk about why it's too expensive, right? And this is the key thing here that's important to understand. I'm going to link another video in the description. Watch it after you watch this video of a guy named Warren that I found out about yesterday because my buddy Tom Nash tweeted about him, and he did a reaction video to these guys' analysis on Tesla. These guys think that Tesla should be trading at like $150 right now. And as a result, they have not invested in Tesla. And one of the guys in this video who's friends with the other guy, he sold all of his Tesla before the big run up and he missed out on like $1 million. He said that in one of the previous videos. And he felt bad about it. But this guy, I think his name is Mo, he was like, you shouldn't feel bad because it's our process, right? And our process is our process. And our process is golden. Which means if our process is you don't overpay for growth, you don't overpay for hype, then we're not going to overpay for that. We're going to stick to our process, and that's going to make us intelligent, due diligent investors for the long term. And the thing is, that's not a bad process. For the average person, that's a pretty good process. The problem is there are moments in life when you make outsized bets. There just are. Now, should you make outsized bets on every company in the world that you think is hype and in growth and has a lot of potential? No. But the people that made outsized bets on Tesla that these guys could have done, that they've talked about in a lot of videos that they didn't do, and they don't regret it because of their process or whatever, they missed out on a lot of money because they didn't understand the fundamentals of Tesla. And that's the problem. What these guys think are fundamentals when we're talking about specific companies like Palantir and Tesla, I'm not talking about all the high growth tech hype companies. I'm talking about really intrinsically valuable companies, at least that I believe from the research that I've done. You have to evaluate them on different paradigms. And it's like, I don't understand why when we're going into a technological revolution, a revolution that we've seen that has never, ever happened before, these guys don't want to change their paradigms. It's like, why are you thinking the same way? That's why you missed out on these companies. So, that's sort of the first thing I want to say right here is that if you're not going to change your paradigm, you're not going to get different results. And if you're going to classify certain stocks as stocks that are horrible because of your old faulty paradigm, which may work for a lot of stocks, but doesn't work for these specific stocks because you have not done the analysis on these specific stocks, maybe because you don't want to, that's fine. But that doesn't mean that's the right way to think about it.
Elon Musk, too expensive. I love Jeff Bezos, too expensive. I love Amazon, too expensive. I can love the person, the company as a company, but not like the price. It's been proven time and time again. If you overpay for something you fall in love with, you are going to end up hurting. Hurting can still mean making money, but not making as much money. SPY is up 20-some% this year. Palantir is down 30%, down 60% from its peak. Great. That's just maybe a fluke. I don't know. But the point is, we're trying to teach a process that if you overpay for cash flow, if you overpay for revenue, you will end up not doing as well in a long period of time.
Okay, so a couple of things there. I'm happy he caught himself when he said it might be a fluke, because if you were to evaluate SPY versus the S&P 500 index, which just had a record-breaking year, versus Palantir, like, in this type of year with all of this artificial money that's been pumped into the economy and everything that's been going on in COVID, like, it would be really, really silly analysis, very bad analysis to be able to just be like, oh, you should have definitely invested in SPY over Palantir, right? Because you sound right in the moment, but it's like, it's one of those things where you sound so right in the moment that everyone knows, oh, this is obviously why you're right. It's because of like what has happened in the market that makes it feel a little bit disingenuous. So I'm happy he caught himself there. The second thing I wanted to say though is, again, his process, right? You don't want to overpay for growth, overpay for revenues. They're not getting into any of the numbers, as you'll see in this video, on Palantir's actual numbers. The fact that Palantir is performing in guidance, a little bit ahead of guidance. The fact that they're having decent amounts of revenue per year, $392 million last quarter. I mean, that's in line with their guidance. You're not overpaying for that level of growth, and that's in line for the amount of growth that they are projecting based upon the deals that they were going to have as the first year of being a public company. Like, that's phenomenal stuff. Now, are the numbers enough to justify the stock being at $100? Obviously not. But to just say you're overpaying for growth without even mentioning some of the growth metrics that Palantir has, which it's been growing on every single metric, not at the levels of like $1 billion of revenue, but if you say we're going to get something and you get a couple million more, that's pretty decent as a growth company in your first year of being public, and you just ignore that and you just generalize it, then that to me is a little bit faulty when analyzing it.
Is that a for sure? No, I was wrong on Amazon. I didn't think Amazon was going to grow like it grew in the last 5 or 6 years. Okay. That's fine. But this process works over long periods of time.
Okay, here's the next thing I want to talk about here. I know I keep pausing here, but this is the really important thing to understand. He's correct. The process works over a long period of times. Like, yes, the process works over a long period of times. The problem is, again, there are moments when you're supposed to make outsized bets. The people who won on Amazon, they took away their old paradigms of thinking about value and growth stocks. And they realized we're going to overpay because this company is going to be integrated into every facet of people's lives. AWS started in 2006. 2014 was the time really to buy Amazon before it really took off. AW6 had been around for a while. You, Mo, whoever, right? It's not directed at Mo, but whatever, you didn't do the research. You didn't do the research on how brick and mortar was dying. You didn't do the research on how consumers loved 2-day shipping. You didn't do the research on Amazon was going to challenge Netflix for Prime Video. You didn't do the research. And that's not your fault. That just means, well, that is your fault, but that's not a reason why, picking certain stocks is bad because it goes against your process. Because sure, your process can be right long-term, but if someone has actually done the research for the stock, then of course they should do the investment if they have the conviction for it. If you've done the research, then you should be able to have the conviction to make that investment. Now, Amazon turned out to be okay. If you had made that level of an outsized bet on a bunch of other companies, you probably would have been wrong. I think that's his point. It's like, well, if you stick to a process, you'll never be wrong. You'll have at least somewhat of a decent return. That's totally fine. The problem is, if you knew Amazon was going to be the thing, like I feel Palantir is going to be the thing, people in 2019 felt Tesla was going to be the thing, and he's like, you're overpaying for them. It's like, you're wrong. You're not overpaying for them because they're going to be the thing. So I think his beef is like, people don't know which thing is going to be the thing and they end up chasing and they lose a lot of money. And that's a safe, responsible thing to say. And I understand that argument. But if you do know it's going to be the thing and you have the conviction to say that it's going to be the thing, then it just matters if it's the thing or if it's not the thing. The thing being if it goes to the moon. And if you're wrong, you're wrong. But if you're right, you're right. And I don't think you should be betting on every single company in the world that you think is going to be fantastic. But if you've done the due diligence on certain types of companies that you know something about that other people just don't understand, like Tesla, like Amazon, then you probably have a chance of winning.
And it's been proven time and time again that every single year, only 82% of mutual funds do not beat the stock market. And over a 10-year period, it's practically like it's even lower. It's what, 0.5%, 1%? Why even try to fight that? Just go put your money into an ETF, follow the S&P 500, and go to sleep well at night and know that you're betting on the U.S. economy. That's it. You're just betting on the U.S. economy because the S&P will do pretty much as well as the U.S. economy does over long periods of time. And the U.S. economy is still the number one economy in the world. As much as we're going into socialism, we're still less socialist than most of the other countries in the world. I'm okay with that.
So if that's the case, why do you have a YouTube channel? Like, if your whole point is go buy the SPY, the S&P index fund, what's the point of your channel, right? Like, this is the weird thing about this channel that I don't get. It's like you can have this approach to value investing and whatever, but people want to know about specific stocks, right? So if your argument is just like, well, don't bet on any of these stocks, just bet on the SPY and sleep well at night and bet on the U.S. economy, then it's like, okay, but like, why are people watching your videos then if that's your message for everything? Like, well, and the reason why is because they sell the software. And look, you got your hustle, you got to do what you got to do. But they analyze all these stocks and they show them that they're undervalued using their 8 analyzer tool or whatever. And at the end, there's a sales pitch to buy their software, which I'm fine with. I don't care about that. But my point is, you have done zero research on Palantir. You have no idea what the company does. You know that they're founded by Peter Thiel. And you say, forget them, buy the SPY. This is the issue. It's like if you haven't done research on a company and you're just classifying them as just one of these other growth hype stocks, then of course you're going to say just buy the SPY. But this video doesn't make any sense then because you're not actually comparing what Palantir does and why you're overpaying for growth right now in comparison to the SPY. Because if I believe that you will beat the SPY very heavily over the next 5 years if you were to make if you were to bet on Palantir. That's just personally my opinion on it. Because I've done the research on Palantir, this is what Dave Lee and Rob Maurer and all these other people felt in 2017, 2019. I mean, Dave has been since like 2012 or something in Tesla. They knew it was going to be something bigger, right? This is what people felt about Amazon in 2014. This is what people felt about Netflix in 2013. So like, if you feel these things and you have the research, then the SPY makes no sense because the SPY just aggregates a bunch of companies that are old and boring. And yeah, they'll have some return. But if you actually do the research on the ones that are winning, then you have a chance to actually beat the SPY and you make more money, right? But like, you got to do the research on those companies. And the fact that he's just classifying Palantir versus SPY doesn't make any sense because you're not doing any analysis on the fact that Palantir actually has something really valuable that is worth, again, quote unquote, overpaying for.
So at the end of the day, you can pick individual stocks, and Palantir has just been an overhyped stock. It's a company selling for 26 times sales, even though the average software company sells for between 6 and 7, 6 and 10 times sales in this overpriced market. I just think there's going to be a come to Jesus moment at some point with Palantir. Doesn't mean the company's going away. Doesn't mean the company's going to zero. Doesn't mean any of these things. But what it means is you're overpaying for growth.
Okay, so here's the problem here. First of all, a lot of software companies are actually not going for 6 to 7 times sales. Snowflake is another example. Some of the software companies that he may be invested in are selling 6 to 7 times sales, but a lot of other companies are 20, 30 times sales. Second of all, this is, again, he's catching himself. He's like, that doesn't mean the company's going to go away. That doesn't mean the company's going to go to zero. The reason you're saying that stuff is because you're very cautious because you know nothing about the company. And again, this is the beef I have with this channel. They like pick all these stocks to probably put the name in the title so they can get more clicks and like scare people and say that they're overhyped, but they don't know anything about the stock. It's like, that's why I'm saying the channel is kind of weird. It's like, you know nothing about the stock. You just know about your analyzer tool that says that the stock is overpriced on your metrics. The paradigms by which you evaluate things really matter, and you have the wrong paradigms. So here, he's saying you're overpaying for growth. Again, if you know nothing about the company you're actually investing in, then how can you logically say you're overpaying for growth? Your numbers in your paradigm may be saying you're overpaying for growth, but if you're valuing the company on a different, like if you bought Tesla at $180 in May 2019, and I remember this because I took like 4 shares at $180 and I sold it at $350 like an idiot, pre-split. And analysts were saying it was worth $10 at the time. I kid you not. There was an article that came out. It's like from some JP Morgan analyst or something. It said it's $10 a share. And I think that's why the price went from like $240 to $180. I remember May 2019, I saw this happening and I was like, this is a buy. I have to buy it. And I knew nothing about investing at that time, but I was just like, it seems like it's really underpriced. And analysts were saying it should be $10 a share. Now, why are analysts saying this? Because they are coming from their MBAs and their Wall Street perspectives, where they think there is no way the car company selling this amount of cars with these margins based on these amount of deliveries should be selling anywhere near the prices of Toyota or a Hyundai or a GM or Ford or etc. But they didn't understand that Tesla was not just a car company. They had a lot of other elements to it. And we don't have to get into that. But that's why if you had just bought the SPY over Tesla at that time, you would have missed out on a lot of money like these guys did. And the problem is they're using the same comparison with Palantir. Now, is Palantir going to be the next Tesla of data? I don't know. I believe it will be, but am I 100% sure? I don't know. The problem is I've done analysis on the company. I actually have a lot of research that's building my conviction to be able to say this. These guys have their 8 analyzer tool numbers, PE ratios, whatever, that tell them if it's a buy or not a buy, if you're overpaying or not overpaying for growth, without even understanding the quality of what you're overpaying, quote unquote, for in the first place. Because if you bought Tesla at 180 in May 2019, you were not overpaying. Because Tesla now is about like 5,400 something post-split or pre-split. So 180 to 5,400 in the matter of a year and a half, 2 years. You don't usually get that return in most people's lifetimes, okay? And like, but so was it overvalued at the time? No, of course not. So when someone says overvalued versus undervalued based upon their paradigms, you really have to question, what are your paradigms, and do you even know the company you're talking about when you're saying you're overpaying for growth? Okay, so their video is 11 minutes, but that's pretty much all we have to react to. The rest of the video, I'll leave it in the description. You guys can check it out, is them talking about managing downside risk. And so they're not doing any analysis on Palantir, right? But this is a video about Palantir. They're literally just talking about this Charlie Munger quote about how sometimes it's better to not do anything versus do something that's risky. And they're analyzing like a long-term process of thinking. None of it has to relate to Palantir. None of it's about the fundamentals or technicals of Palantir. All they're talking about is like, should we wait on our money before we actually do something and be more patient, which is like philosophical investing advice. And then the last part of their video is trading Palantir on the charts through day trading. And it's like, that also adds no value, because it's like, so you're just teaching people to day trade now, but I thought you guys were long-term investors or like value investors. How is day trading value? I don't know. It's just really confusing. Again, I like this channel. They're cool guys. I listen to some of their stuff. It definitely influences my perspectives. It keeps me out of my own echo chamber of just thinking like growth is important. So I really do value their content, but it's videos like these where they don't go deep into companies. Like they just pull up their software tool and they say like, hey, this is overvalued. And it's like, but we don't know what the company does. And again, if you thought Tesla was overvalued and you knew nothing about Tesla, then you wouldn't have paid for it and you wouldn't have made the returns. I'm not saying that you should be overpaying for all of these growth companies. Like, I don't own Teladoc. Like Kathy Wood is telling me that Teladoc's going to be the next biggest thing. I know nothing about Teladoc, so I can't buy it, because then I would be philosophically overpaying for it because I know nothing about it. I can't tell you what I'm paying for. But I know about Palantir and I understand about Palantir, so I don't feel like I'm overpaying for it. These guys don't know anything about Palantir. They don't know anything. They don't know anything about most of the stocks they talk about. They just know their analyzer tools. And that's why in the next 5 years, they're likely not going to make a lot of money on these stocks that blow up. Now, their final argument will be, well, if we bet on all 100 of the stocks that we thought would blow up, most of the time you're not going to beat the market. So you might get one of them right, but that one is going to pay for all the 100. So you're going to end up breaking even. It's like, well, then don't bet on 100. Bet on the ones that are going to win. Seems pretty simple, right? If you bet on the ones that are going to win and then they win, then you win. Their counter argument to that is going to be like, well, you don't know which one it is going to be. My counter argument to that is you don't do research. You don't research, because I do research. That's why I know Palantir is going to win. I do research. This is not financial advice. This is my advice to myself. I'm talking to myself. This is my own opinion. I think it's going to win. I know it's going to win to myself because I've done the research. If you haven't done the research, then whatever. Now, could I be wrong? Yeah, I could be wrong, but I don't think I'm wrong. And I'm not out here putting $30,000, $40,000 into tons of these growth tech stocks, because the amount of research it would take for me to have the conviction to do that would take years. I don't have that time, but I do have the time to focus on one of those stocks. And that's, or, maybe two, maybe three. I haven't added too many other positions. I'm looking into some other companies, but Palantir is one of those stocks that I know really well that I believe is going to win. So when this argument about just pick the market, don't pick those 100 growth tech stocks because one might win, but you're going to die for the other 100, the other 99. It's like, well, then pick the one that's going to win. And if you're bad at picking the one that's going to win, then you're bad at doing research, you're bad at doing your due diligence, you're bad at doing investing. That's fine. And all of us are going to make those mistakes over time. I mean, I made those mistakes for a ton of other companies. But if you believe in the one that's going to win and you know there's logical foundation for the one that's going to win, I mean, Tesla is the most obvious example. If you could understand what they were really doing, and I don't really have to go into that, but if you know what they did, you know what they did that was fundamentally different. They were tech over just selling pure cars, energy storage, AI, data. I mean, there's so much stuff in there. Then it was very obvious why they were going to be the monopoly. I did a whole video on Wright's Law. I'll link that in the description. It's really important. This was a literal scientific principle that predicted the cost of lithium-ion batteries getting to such a low level that would explode the prices explode the demand for electric vehicles, because the economies of scales would be operating at such a level by which it would be so cheap to actually make electric cars, which means margins on those cars would increase, which means profits for Tesla would increase. But you got to know that stuff. You got to do that research. And if you don't do that research, then you're never going to be able to win. And to win on outsized bets and take risks, you've got to do a lot of research. You can't just be willy-nilly about it. And I've done the research, and these guys haven't. They don't know anything about Palantir. Still respect them, though. Thank you guys for watching. Let me know your thoughts in the comments, and I will see you in the next one. All right, guys, I figured it out.